Okay, students. Today we are going to discuss our tutorial questions on fundamentals of capital budgeting. So you remember that in our investment decision rules and all those chapters, when we were calculating NPV, we were doing CF, that was initial cash outflow. Normally it was an inflow. Then we had CF1, 1 plus R power N, and so on, right? So we used to do all of these cash flows. So previously, when I had taught you investment decision rule, so these cash flows, they were given, right? So, but now, how do we get those cash flows and where to find those cash flows? Is there any way that we can calculate these cash flows? This chapter actually deals in the estimation of these cash flow. Okay, so it means that this is an input. This is an input to calculate NPV. So previously this input was given, but now this is a separate chapter which will target how to estimate these cash flows. Okay. So now we are getting into more detail of the cash flow estimation, and then you will see that in the next coming topics. And also this cost of capital is also largely given. So in next coming lectures, we will see how to estimate R. So that chapter is called cost of capital. Okay. Now it means that we have now started working on the inputs, individual inputs that we were doing before. They used to be given. The question had that information before, but now we are calculating it. Okay, so it means this chapter is going to estimate the estimation of benefits, because in our decision, we compare our cash flows, or in other words, benefits, with the cost. And the cost chapter will start from the following week, okay, when we will discuss cost of capital. Okay, so let's look at the first question. Coco Mochi is considering the launch of an advertising campaign for its latest dessert product, the Mini Mochi Munch. The company plans to spend 6.2 million on TV, radio, and print advertising this year for the campaign. So it means that this 6.2 million is an advertisement expense. And we normally okay, one of the student asked me, sir, where can I find the questions on the capital budgeting? Did the questions will be in week 7, because under risk and return. So I will show you, okay? So once I complete that, so I think it is under risk and return chapter. So if you go to that chapter, you will find these questions, because you know that the questions this week I will upload the lecture on risk and return. So that is why this week we are going to discuss tutorial questions of the previous week. Okay, so you can find that under risk and return chapter. Okay. I will let me check that in that case. So is it okay if I do it now and later I check it again? Okay, thank you. So maybe while uploading, I forgot to show it. So please pardon me if you cannot see that. So I will do that after this lecture. Okay, so 6.2 million is the advertisement expense. The ads are expected to boost sales of the main product, Mini Mochi Munch, by $10.2 million this year and by 8.2 million next year. So this is sale in year 1 and this is the sale in year 2. In addition, the company expects that the new consumers who try this product will be more likely to try another product of the company. As a result, the sale of the products are expected to rise by 2.2 billion. So it means in the restaurant, when you introduce a new product, so you are expecting the sale of product A by 10.2 million. Product A means a new product, and 8.2 million next year. So at the same time, you know that when the customers, they go to restaurants, they also try other products. So they are also expecting that the other product sale will also increase by 2.2 million each year, mean in year 1 and in year 2. Okay, so now, so we have product A and we have product B. We have year 1 and year 2. So 10.2 million and 8.2 million and 2.2 million and 2.2 million. Sale of A, sale of B. Okay, so this is the given information. The company gross profit margin for the mini mochi munch, mean the product A, is 39% and its gross profit margin averages 23% for all other products, for product B and all other. The company's marginal corporate tax rate is 35% both this year and next year. And what are the incremental associated earnings with this advertising campaign? Okay, so before I discuss this chapter in detail, so we have to understand a few things. That when you will see these questions, the question may come in different forms. Number one, okay, you can expect the information in the question starting information, okay, in 3 possible ways. Number one, the question will directly give you sales, okay, because at the end we need to do these things. Sales minus CGS, we will get gross profit, and we will do the expenses like advertisement expense, rent, okay, then depreciation, and we will get what? Earning before tax. Though we get earning before interest and tax, we get interest and tax, but this interest will be adjusted in the denominator. You will see when we will do cost of capital. So that's why we do earning before tax. So after that, we do minus tax, and then we get EBT, sorry, earning after tax, and then we add back depreciation to get cash flow. If any other adjustment, we also do. But the point I'm trying to make is that when you see the questions on the cash flow estimation, the question might directly give you sales, okay? So it will directly give you sales and cost so that you can calculate GP, and you will also calculate some depreciation, and you will reach EBT. Once you reach EBT, then you rest of the process is same. So it will directly give you this information, as well as sometimes sometimes the question does not give you cost of goods sold, right? So it means either the question can give you CGS as well as cost of goods sold, then it's very easy to calculate GP, right? Gross profit. So, but sometimes the question does not give you, the question gives you sales. This information is given, CGS information is not given, okay? Then what information would you expect from the question? Because we need to calculate the GP, right? So to get the GP, the question will give you gross profit margin, okay? So some percentage of the gross profit margin will be given. So gross profit is also equal to sales multiplied by margin, profit margin, okay? Gross profit margin. So it will, you can easily get gross profit then, okay? So may I ask you whether in this question, are you given the information on sale and CGS both, or sale and gross profit margin? Point number 1 and point number 2. Which information is given in this question, students?
Number 2, sir.
Number 2, very good. So it means that in this question, we have to reach gross profit. The question will either give you that both the information, sales CGS, or it will give you gross profit margin. So gross profit margin information is given. So it means this situation applies. Okay, this is situation number 1. Situation number 2 is that the question does not give you the information of sale or CGS. Instead, the question gives you the information of its component, because if you see sales, sale is equal to price multiplied by quantity, right? Quantity sold. Correct me if I'm not right, okay? Then CGS is equal to cost multiplied by quantity, right? Similarly, we can also estimate gross profit is equal to How can we do that? It will be P minus C multiplied by Q. Okay, so what do we get from this information? The question either gives you the information of sale and CGS directly, and then you get the GP, or the question gives you sale or CGS. In our no CGS, then gross profit margin will be given. If you don't find the no information like we discussed in part 1, the question might give you the information, starting information in this way. Like the question will give you the information of price and quantity, cost and quantity, and then you will get gross profit. Once you have calculated the gross profit, then rest of the process is easy. Okay, so these could be the variations, and you will see that we will discuss that in the coming questions. But for now, you have to understand that the question may give you different variations. Okay, so don't get confused. So it will be very easy once you know that if situation 1 is there, 2 is there, or maybe situation 3 is there, so you need to calculate. Or maybe the question gives you the information of price and quantity, but for the gross profit, again, it will not give you C into quantity, maybe gross profit margin. Okay, so it could be a variation. So you can expect some variation in the information of the question. Okay, so this is a very important point that you should remember, these two informations. Once you know that, then questions, they become very easy. Okay, perfect. Now we have cost of capital, tax rate is 35%, cost of capital is no, it's not given. Okay, so no problem, we don't need that because the question did not ask us to calculate NPV. Okay, so now the question is asking us to calculate the incremental earnings. Incremental earnings mean the difference of the earnings that you're getting. Okay, so I will explain. Okay, first of all, product A and product B. So this is the sale in year 1, sale in year 2. Okay, this is the sale in year 1 and 2 for B. What is the gross profit margin for the mini monument? So you need to multiply sale with this gross profit margin, and you will get this one, this answer. Okay, similarly, you will multiply this gross profit margin to the sale of the product B, and you will get gross profit margin of B, and this is for A. Okay, so now you have both the gross profit margins of product A and product B, product A and product B in year 1 and 2. Simply add them and you will get incremental gross profit of A, incremental gross profit of, in year 1 and in year 2. Okay, so this is called incremental. In cash flow chapters, you will always hear a word incremental. Okay, so everything, every single thing that you are going to do here, it could be incremental sale, incremental cost, incremental gross profit, incremental depreciation, incremental rent, or incremental anything. Okay, so incremental means if you make a decision, what is the outcome of that decision that is happening in our decision making. Let's take an example. For instance, I know that you might have understood the concept of incremental, plus please remember that this incremental concept applies to every component that you see here. Okay, it could be everywhere, but normally we say incremental sale, incremental gross profit. Okay, so let's say if you have a machine A, okay, and machine B. Okay, through machine A, you are producing 1,000 unit every year, year 1, every year same unit. But if you bring machine B, you can produce 200,000 units. Okay, so it means that this incremental decision is affecting. If I say, okay, please hear me very carefully. If I say that when you had this machine A, the quantity sold was 100,000. Okay, and what is happening that if you bring a new machine, the capacity of the machine is high and you can produce 200,000 units. Okay, so can you tell me whether this decision of mine is affecting sales, CGS, or which component is it affecting? Because for sale price and quantity, C and quantity, right? Is this decision affecting the price of my product? If I bring a new machine, its capacity will increase from 100,000 to 200,000. So can you tell me whether this decision of mine in shifting from machine A to B is my decision, right? So how is this decision affecting the components in the cash flow part? Is it affecting quantity? Is it affecting price? Is it affecting cost, or is it affecting Q? How is that? Anyone? Okay, may I ask you, if I bring a new machine, am I increasing the price? Anyone?
I'm sorry, sir. What's the question?
If I bring a new machine from A to B, right? The production capacity of A is 100,000 and the new machine's production capacity is 200,000, right? So it means an increase of how much? Almost half of that, right? So it means that if I switch from machine A to B, my decision of switching from A to B is affecting surely the sales and CGS and all the components, but it is largely affecting which part of the estimation, P, C, or Q? Very good. It is quantity, right? One of the student answered that it is quantity because I can say that incremental quantity, okay? Though it will increase the sale and as well as it will, my CGS will also increase, but and similarly my GP will increase. But as you can see, this decision is particularly aimed for increasing the quantity, right? So it means I can say incremental quantity, right? So similarly, if you affect this price, it will surely change the sale, but I will say that what is the incremental effect of the increase in price? What is the incremental effect on the increase in quantity? What is the incremental if I increase the cost, right? So you can say that if you make a decision, that every decision that you make should have an incremental effect, right? So let me just give another example. I will carry the same decision. Why should we do that? For instance, the old machine had a sale of 200,000. New machine is giving us a sale of 300,000. This point is very important, okay? So it means that the cash flow estimation or finance says that while you do the evaluation, while am I doing the evaluation, I should not consider 200,000 and 300,000. I should take the difference. Okay, so it means that difference is 100,000. So it is called the incremental additional cash flow or additional benefit that you're getting, because previous machine was giving me a sale of 200,000 and new machine is giving me 300,000. So it means that 200,000 is already there. So how much extra am I adding in? That is 100,000, because this 2,000 and this 2,000 is already equal. So how much extra am I getting? 100,000. So that is why in the evaluation, you will do the incremental. So this is called incremental effect on the cash flow or the other benefits. Now, when we will discuss the question, you will see, I will explain it with the real example that are given here. Okay. So as you can see, by launching a new product that was Mini Mochi Munch, what happened that the sale of the other sale of the other product also increased, right? So that is why the gross profit margin also increased. So because both of them were new, so that is why this is our incremental gross profit. Okay, so this question did not ask you to go for the cash flow estimation. So the question just stopped at this part, only at gross profit part, at this part. Okay, So next question, we will move further from GP to some other part. Okay. Sorry, we are continuing because the depreciation, sorry, my bad. Because there were some advertisement expenses also given, and the tax rate is also 35%. Okay. So can you find any depreciation in the question? There is no depreciation given, right? So it means, so you will have incremental gross profit year 1, incremental gross profit year 2, selling and admin expense, it will only happen in year 1. Okay, so this will be negative profit. Okay, and in year 2 there will be no selling and administrative expenses, no depreciation, so this will be your profit. Okay, since it's a loss, so on loss you don't really pay taxes, right? So it will be a tax benefit, so it will be positive, and your answer will be 1716 will be negative 1115 000, and in this case 3704 35% will be tax paid, and this is your profit. Okay, so in the first case, as you can see, it was loss, but it is not a tax expense now. Okay, so it is a tax benefit, so that is why I have written it positive, while when you were making some profit, now you are paying some tax. When you are making loss, you are not paying any tax, so it is an inflow. Okay, may I ask you a question, and I would expect you to answer that. If I say this is a tax saving, right? 601,000, does it mean that the government will pay me 601,000? When I say that this is my tax saving because I made a loss, so does it mean that government will pay me 601,000? No. Why? Why? It means that the government will tell me that since you have made loss, you don't need to pay a tax of 601,000. When I am not paying, actually I'm saving, right? So that is why it is positive. Okay. Let's take question number 2. Hyperion Incorporation currently sells its high-speed color printer, the Hyper 500, for 349. Can you see that? This question has given you the price of the product, right? Okay, it plans to lower the price to 300 next year. So it means the company is making decision to change the price. Okay, so it means that this price will bring some incremental effect. So this is current price, and this is the price that the company is expecting to lower in next year, right? So its cost of goods sold for the Hyper 500 is 192. So it means that this is cost of goods sold. This is C. And this year's sales are expected to be 26,100. So it means this year. So quantity 0 mean this year. Okay, 1 mean next year. So, but remember that I'm not writing C0 or C1. May I ask you why? I'm writing P0, P1, Q0, and if you see that, suppose that if the Hyperion drops the price to 300 means P1, it can increase the year's sales by 30% to 33930. So it means that when companies, they give discount or they decrease the price, of course, the quantity will increase. So this is Q1, mean at year 1. What could be the incremental impact on this year's EBIT of such price drop? Mean the company is changing the price. So the price has some incremental effect on the cash flow. Okay, my question to you was that you see that we have two prices, P0, then P1, okay, Q0 and Q1, but C is same, right? So should I keep the C0 and C1 same or not? Anyone? Sorry. The students who are sending me in a private message, kindly send it in the in public so that we can discuss. Okay, so this is for everyone so that we learn from each other. Okay, should I keep C equal? Mean C0 should be C1. Yes, because the company did not change the price. Very good, Carl. Yes, we should not change C because C will remain the same. But of course, we know that when price will change, it will affect the quantity, but the company is not changing cost, right? So that's why the C is same for both of them. They are equal, okay? So now, as you can see, I told you in the start that the question either gives you the information of direct sale, then CGS. If not, the question will give you the information of price and to quantity to calculate sales, C and to quantity to calculate CGS, okay? So now the question is dealing the second part of information. Now, so what would be the incremental effect on this year's EBIT? So we need to calculate the effect, okay? Okay, so if you see this information, you might get confused, but this question is like this, that sales, CGS, gross profit, okay? So sale is equal to new sale minus old sale, new minus old, gross profit is new minus old, okay? So if you see this information now, if I write it in the form of price and quantity, it is equal to price if at year 0. Okay, so price into quantity, C into quantity. If I say current price, okay, so it means that I can write price 0, Q0, Q0. Okay, so it will be gross profit current will be equal to P naught minus C multiplied by Q naught. Am I right, students? And if I say new, mean this is today and at year 1, I can write new price, mean also new quantity, okay? In other words, cost is not going to change, but the quantity is going to change already, right? Q1. So it will be P1 minus C into Q1. Correct, students? So this is sale, new cost, and new gross profit margin. Okay. So that's why if you see this question, since there is no depreciation given, so no other expenses are given. So after that, there are no expenses given. So that is why this answer is equal to EBIT or EBT. So that is why if you see the question has written change in EBT. But if you don't want to write change in EBT, you can write change in gross profit. Okay, no issues. So gross profit with the price drop mean the new minus old. Okay, so this is quantity, new quantity Q1, 300 is the new price. This is P1 minus C. Okay, so second part is the old one, original, the current price, the current quantity is Q0. Then initial price minus C. Okay, so if you see the difference, it means that this is equal to gross profit, new, and this is equal to gross profit, old. So difference is equal to this difference, negative. Any issues so far, students? So if you want to write it here, you can also do that, but this is what they have done. So difference of the two gross profits. So this formula is gross profit, this new, and this is old. If you take the difference, you will get the answer. Clear so far, students? Any question? Any questions, students? No question. Okay. Suppose that for each printer sold, the company expects additional sale of 89 per year on ink cartridge. So it means that if you drop the price from 349 to 300, it will not only increase the sale of your printer, but it will also increase the sale of the ink cartridge. The person who is going to buy the printer will of course buy the ink cartridge as well, right? So that is why it has an incremental effect on the sale of ink cartridge as well. Okay. So the price for the additional okay, expects additional sale of 89 per year on ink cartridge for the next 3 years. So it means 89 is the price of uh, the ink cartridge. Okay, so we need to calculate that. And Hyperon has a gross profit margin of 65% on ink cartridge. What is the incremental impact on EBIT for the next 3 years of a price drop this year? Okay, so let's read this information again. So when the company will drop the price from 349 to 300, so the company expects an additional sale. So this is not cost price, actually, this is sale. Okay, so this is sale already, no price or quantity on ink cartridge for the next 3 years. And the company and the Hyperon has good gross profit margin of 65% on ink cartridge. Okay, so in this question, the question has given you hybrid information. So it has given you gross profit margin. Okay, so sale and gross profit margin information is given. Okay, the question did not give you the information of price and quantity for cartridge, but the question gave you the information of price and quantity for the printer itself. Okay, but if you are given sales, you expect CGS, but if no CGS is given, then gross profit margin should be given in the question. So in the question, 65% is given. So what is the incremental impact of EBIT for the next 3 years of a price drop this year? Okay, so let's see change in EBIT from the ink cartridge. So this is sale. Okay, sale multiplied by gross profit margin is equal to gross profit. Okay, is equal to gross profit. So I write it here for you. So in case, so sale, CGS, and gross profit. Okay, since CGS is not given, so we are calculating sale into margin. Okay, so sale mean the new sale 33,930 into 89. Okay, 89 and 0.65 is the gross profit margin. So it means that this part has given you the effect on the gross profit. So if you see similar information, you can apply it for the when the price was not changed. So this was the gross profit when the price drop was not there. So new minus old, same thing. So this is the gross profit or change in EBIT on the ink cartridge. Okay, so now you have the profit from the printer, and now you have the profit from the ink cartridge. Ink cartridge. So if you add them both, so this will be your additional or incremental benefit that you can get. Okay. Now, I think there is this information is not correct. If you see this information, this should not be the sale. This should be price of ink cartridge, because if this is sale, then we should not be multiplying it with the quantity, because if it is sale already, then there is no point of multiplying it with 89. Okay, so this is quantity and this is price. Sorry, this is not sale, this is price. Okay, so price into quantity will give you sale multiplied by gross profit margin. It means it will give you the gross profit. Similarly, the quantity into price will give you sale multiplied by gross profit margin will give you gross profit. Old, gross profit, new, similar to what we have done in our previous question. So this is you can get. Okay, so this information I will update it once I do that. Okay. Okay, so next question is tax depreciation expense. The tax depreciation expense, you have a depreciation expense of 500,000 and tax rate is 35%. What is your depreciation tax shield? So this is very easy to understand, because if you have gross profit of 100, okay, and then depreciation situation A and situation B, okay. So let's say gross profit of in both situation is 100 and 100. In situation 1, there is no depreciation. In situation 2, let's say depreciation is 20, okay. So then you will get earning before tax is equal to 100 is equal to 80. So let's say then the tax rate is 50%, I'm assuming, right? So if you see how much will be the tax on 100, it will be 50, and in this situation it will be 40, okay. So the answer earning after tax would be equal to 50 and it will be 40. Okay, my question to you is that if you see, when there is a depreciation expense in the estimation, you will see that you are paying less tax. You see 40 here, but if there is no depreciation, you are paying a tax of 50, okay? So you are paying more tax if there is no depreciation. You are paying less tax if there is a depreciation. So it means the presence of depreciation is helping you to save in situation B a tax expense of $10, right? So this is called the tax benefit of the depreciation. We call it as depreciation tax shield. So it means that the presence of depreciation helps you to save some taxes. So that is why it is called depreciation tax shield. So how do we get it? So it means that what is the depreciation? That is 20. And how much is the tax rate? 50%. So what should be the answer? It should be 10, right? So same thing we can see from this question, that the depreciation expense is 500,000. Okay, if you see, you have a depreciation expense of 500,000 and a tax rate of 35%. What is your depreciation tax shield? Simple. Simply multiply this depreciation with the tax rate to get the answer. But the more important thing is that you should know what does that mean. So it means that the presence of a depreciation expense of 500,000 is helping you to save 175,000 in situation when there is no depreciation expense compared to a situation, okay. So this depreciation expense has a tax benefit, okay. Now we come to very hardcore questions on cash flow estimation. So we have question number 4 and question number 5. So we will be spending more time on these questions. Okay. So let's take this question. 1 year ago, your company purchased a machine used in manufacturing for 110,000. So the question is saying 1 year ago. So it means you are here, but the question is saying last year, right? So last year, the cost of the machine was equal to 110,000. Okay. So this is T minus 1 and this is 0. Or in other words, T0. You're standing here. Okay. So you bought it last year, 110,000. You have learned a new machine is available that offers many advantages and you can purchase it for 150,000. So it means that here you have realized that you should buy a new machine. The cost of the new machine is equal to 150,000. Okay. So, okay. So far we have already incorporated this information. This is last year and this is now. It will be depreciated on a straight line basis over 10 years time and has no salvage value. So it means that once you buy this machine, it will be depreciated for a period of 10 years, means we can use it for 10 years. And the depreciation would be straight line method. It means, so 150,000 and 10 years, means 15K would be the depreciation every year for new machine. Okay, so we got it. So it means that we got the information of cost and also we got the information of depreciation. Two informations we collected. Okay, you expect that the new machine will produce a gross revenue, gross operating revenue minus operating expenses other than depreciation of 40,000 per year for the next 10 years. So it means that when you will buy this every year, you are going to make a profit of 40,000, or in other words, a gross profit of 40,000 every year for 10 years, 40K for 10 years. So far, I mean, no issues. Okay. So it means that the cash flows are equal. So the cash flow is equal to 40,000 every year for 5 years. For information number 1, 2, and 3. Okay. The current machine mean this machine that you had bought last year. Okay, is expected to produce a gross margin of 22,000 per year. So this machine you can see is producing 40,000. But if you continue this machine, so it means this machine will give us 22,000 every year for how many years? For how many years? 11 years, because its useful life is 11 years. We bought it last year, so it was giving us 22,000 already. So it means this machine was giving us a gross margin of 22,000 for 10 years. New machine that we are thinking to buy is going to give us 40,000 every year for 10 years. And the old machine was bought last year and it has a useful life of 11 years and has no salvage value. Mean after the end of its expiry, there is no salvage value. So the depreciation expense for the current machine is 10,000. So the current machine, if I calculate its depreciation, so it is cost minus depreciation divided by life. Okay, will be the remaining value or the book value. Okay, so this is, sorry, we will calculate it later, but it means that when the company had bought this machine, so the cost was 100,000, 110,000, life was 11 years. What was the depreciation? If you use straight line, so it will be 110,000 divided by 11 is equal to 10,000. Okay, so now you can see that there are two different informations. Okay, so I'm just separating these two information, old machine and new machine. Okay, now so next, the market value today of the current machine means I'm calling it as current instead of old. Okay, current machine is 55,000. So this is an additional information. Your company's tax rate is 45% and opportunity cost of capital for this type of equipment is 12%. Should your company replace its old machine? Okay. So let's put this information in this box. So once you get it, then it will be very easy to. First of all, the market price today, the question has given you that it is 55,000 is equal to 55,000. Okay. And the cost when we had bought it last year was 110,000. Okay. And depreciation every year was 10K and life was 11 years. Okay. So, okay. And then gross profit it was generating is 22,000. So new machine, there is no information because we are just thinking to buy. So there is no market price. In other words, this is also called the book value. No, market price, not the book value. Okay. So we have the information of cost that is 150,000. So depreciation is 15K. Okay. Life is 10 years. Gross profit is 40K. Okay. Now you should take the difference. Okay. So what is the incremental? What is the incremental effect? You will say in the cost, of course, there is some increase in the cost, number one. Number two, depreciation is increasing, right? The cost is increasing. The depreciation is also increasing. Life, it doesn't matter. Whatever is the life, we will deal it later. And how about the gross profit? Are we increasing higher gross profit? Yes, we are getting more gross profit. Okay. So it means that there are three components that should be changed. One is cost, and then depreciation, and then gross profit. Okay. So these parts will be changed. And then there is another information that you should take care every time you see a question is, okay, so let me explain. This concept is very important. This is called after tax salvage value. So once I explain this to you, rest of the question you can see it will be very easy. Okay. So let's say if I have a phone, let me give you an example. Let's say if I have a phone that I had bought last year, and its price and the market price of this, I mean, last year I bought a phone of, let's say, for 2000 last year, right? So, and I know that its usable life is 2 years. So, or maybe 5 years, I would say. So since I have used it for 1 year, so I will say that, okay, so life is 5 years and cost last year was 2000. So it means that what is the depreciation? It will be 2000 divided by 5. Answer would be 40, right? 400, sorry. Okay, so it means every year the phone should decrease its value by 400. So what is the situation here in the timeline? I had bought this phone at 2000. Okay, so what should be the residual value if I'm standing here, students? After 1 year, if I ask you what would be the residual value, please answer me and through your voice so that I don't go to the chat box to see the answer. Last year, I bought it for 2000. I used it for 1 year. And according to my books, so what should be the remaining value of this phone?
1,600.
Very good. So it should be 1,600. So this value, I called it as book value. In other words, residual value so far, right? So that is 1,600. So according to the books, this phone, now if I want to sell this phone should sell. I'm saying should sell, okay? So this phone should sell at 1,100. But it is not the case every time that market buys the phone at the book value, right? For instance, now we want to sell this phone and want to buy a new one. So if you are going in the market and want to sell this phone, so let's say market gives you a price of, let's say 1,800, okay? So it means you will be happy to sell because you are thinking to sell it on 1,600 at least, but market is giving you 1,800. So how much is the difference? So you will say what is the capital gain or capital loss? So you will say this is called the market price, okay? So you will say market price minus book value. In other words, the price in the start and the price once you are going to sell it. So in other words, I mean, don't follow this on the concept. It is just simple market price minus book value. When you will sell it, you will get how much? 1,800. And according to you, the book value of the phone was 1,600. So the answer is equal to 200. So this is called capital gain. So once you get the capital gain, then you have to pay a tax. So this is when this head is called after tax salvage value. Okay. So it means that it should be equal to market price minus tax rate multiplied by capital gain. Okay. In other words, if I just open it again, so it is 1,800 minus, let's say tax rate is 50%. Okay. Just for the simplicity. So this is 50% multiplied by capital gain. How did you calculate? It was equal to market price minus book value. Okay. So 1,800 minus 50% into 1,800 minus 1,600. Okay. So 1,800 minus this, the answer will be 200, and 50% of 200 will be 100. So it means that your after tax salvage value is equal to how much? 1700. So this is situation number 1, when you get more than your book value. Did you get it? So let's say we just reverse the situation. So it is 1400. Okay. You will see that these informations will be provided to you in coming questions. So it's better that we understand it now. Okay. So if the situation is like that, that market is giving you 1400. So if 1400, so 1600 will be the same. So we will just change it to 1400. 1400. So will you make a profit or loss, students, in this situation? It will be a capital gain or loss?
Loss.
Loss, very good. So it will be negative 200. So on loss, do you pay tax? On losses, we do not pay any tax, right? So it means losses are exempted from tax, but it does not mean that we will not do the calculation. We have to do the calculation, okay? So in our situation now, it will be 1400, sorry, 1400 minus 600, but the answer will be negative, okay? So the answer will be negative 100, negative 100 multiplied by 50, sorry, negative 200. So answer will be negative, negative, it will be positive. So answer will be equal to 1900. Not 1900, this will also change, okay? Because market price is 1400 and 1400, okay? And 1400. So answer will be equal to 1500 now. Okay. So this is situation number 2. Situation number 1, market price was 1800. Okay, we have to pay taxes. Situation number 2, market price is 1400, mean less than your book value. Number 3, market price is equal to book price. Okay, so if this is a situation, so what should I expect, students? It means that it is also 1600. So I will just change 1600 minus 1600. There will be 0 capital gain. So the answer will be equal to only equal to 1600, right? So this part will be equal to 0 because capital gain is 0. So answer will be equal to 1600. So in our first situation, our answer was equal to 1900. In second situation, the answer was equal to 1500. And last situation, the answer should be equal to 1600. Okay. So all of these answers that I calculated, they are called after tax salvage value. Okay. So this is, you have to keep in mind. Okay. Now I will also tell you some other situations, but for now you need to understand this situation. And if you apply this on our question, if you see, the question is telling that the market value today of the current machine, mean the one that you had bought last year, is 55,000. Okay. So this is market value, market price. Your company's tax rate is 45% and the opportunity cost of capital is 12% should your company replace its sold machine. Okay. So now, may I ask you, without just looking at the answer, may I ask you what would be the book value of the current machine? Anyone? The current machine was bought for 110,000, life was 11, and depreciation is 10,000. So how much is the book value after 1 year? This machine that we had bought last year for 110,000, we have used it for 1 year only. And if I want to sell it now, the market is giving me 55,000. So what is the book value? So this is the market price, but how about the book value? Anyone? Very good, 100,000. Okay. So if we sell it, will be a capital gain or capital loss, students?
Capital loss.
Very good, capital loss. Okay. So this is we need to do here. So calculate incremental gross profit margin. So is equal to 40,000 is the new machine, 22,000 is the old machine. So 18,000 we will get extra if we buy a new machine. This is incremental gross profit. How about the incremental depreciation? 15,000 is the depreciation of the new one. 10,000 is the depreciation of the old one. Difference is equal to 5,000. So this is incremental depreciation. How about the after tax salvage value? So it means the purchase price of the old one was 110,000. We have used it for 1 year. How much is the book value? This is 100,000. Okay. So book value is there. Now capital gain or tax, sale price is equal to 55,000. Book value is equal to 100,000. This is capital loss. Okay. So then you will calculate after tax salvage value, mean the sale price, another word market price minus tax rate into capital gain or loss. So 55,000 minus 45,000 into 45. So answer is 75,250. Okay. So this is called after tax salvage value. So why do we need to calculate that? Because in the start, when you are going to, it means that if I use the situation of phone, so I had bought it for 2,000 and now I can sell it for, let's say, 1,800. Okay. So after paying the tax, sorry, yeah, it was 1,700, not 1,900. It means that I can get 1,700 if I sell this phone after paying all the taxes. So I will get 1,700. So let's say next phone is for 3,000. So how much? So it means that this will be my inflow. If I buy a new phone, this will be my outflow. Okay. So this will be my cost. And this is my inflow, mean I'm getting some funds by selling my old phone and I'm going to buy a new phone, right? So my replacement decision is giving me how much? 1,700. And it is causing me to put how much? 3,000. So how much is the difference? 1,300, right? So it means this is the incremental cost. So I'm getting a benefit of 1,700 by selling the old phone and buying a new machine. So how much extra do I need to put? 1,300. Okay. So that is why we have to get this information in our decision making. Now let's do that on the timeline. So starting from 0 to year 10, 1 to 10, because incremental cash flows are 40,000 minus 22, so 18,000. Okay, depreciation was equal to 15K minus 10K, 5,000. EBIT will be difference of these two. Okay, income tax, since it's positive, so we are going to pay a tax rate. So what was the tax rate given? That was 45%. Okay, so 45% is the tax rate. So if you apply the tax rate, that will be equal to 5,850. So if you subtract the tax rate from EBIT, you will get incremental earning. Okay, so then you subtract the depreciation. Okay, so there is no change in working capital, no in year 1. Okay, so there are no other requirements, so that is why this will be your incremental cash flow. But in the in year 0, so new machine, the cost of the new machine is negative 150,000. Okay, so 75,250 is by selling the old machine. This is buying of the new machine. How much is the difference in the cost? So that is 74,750. So it means you need to put this much extra to get a new machine. Okay, so this will be your initial cash outflow. Okay, and these will be your incremental cash flows. Since they are equal and regular, so it means we can apply a present value of annuity formula. So if you apply the present value of annuity formula, our answer is negative. So it means it is giving us a negative answer. So we are not going to buy a new machine. Any questions, students? Okay. So before I complete this question, there is another adjustment that you should remember. Okay. So let's say this is over 10 years. Okay. If I tell you in the question that, if I say, if you see the current machine is being depreciated on a straight line basis over a useful life of 11 years. This is for the old one. How about the new one? Yeah. If I change this information, please note it down. Okay. You have learned that the new machine is available that offers many advantages, and you can purchase it for 150,000. It will be depreciated on a straight line basis over 10 years and has no salvage value, right? The question is telling you that it has no salvage value, but sometime, I'm saying sometime, the question also tells you the machine has no salvage value, but you can sell it. Sell it in the market for, let's say, 10,000. Okay. So this can also happen in the question. So no salvage does not mean that it does not have any market price. For instance, take an example. Let's say if you buy a car, okay. So if you buy a car and the useful life of the car is, let's say, 10 years. Okay. So once the 10 years are over, can you still sell the car at some price in the market? Okay. We can see the cars that are even 20 years old, but you can still see that these cars have the market price, right? So it means that though according to its book value, its salvage value is 0, but you can still buy or sell this car at some price, okay, at some market price, okay. So if this situation arises, then you have to do the adjustment in the last year, in this year, okay. So I'm just assuming that the new machine that you had bought had a 0 salvage value. So I will say book value is equal to 0, right? And so far our calculation according to the question is 12,150. So if I see this information, okay. So, but the question is telling you that after the year end, you can sell your new machine that you're going to buy at a market price of 10,000. I'm just saying, okay. So tax rate is 45%. So will you adjust it in the last year, students? Will you adjust it? Anyone? Just make a guess. It means that once the project machine's life is over and its book value will be equal to 0, but market price is 10,000. So should I, because if we sell this machine at 10,000, of course, it will be an inflow at the end of year 10. So we need to adjust it. Okay. So we will calculate capital gain is equal to market price minus book value is equal to 10,000 minus 0. So the answer will be equal to 10,000. Okay. So this is capital gain. So on capital gain, of course, you pay some tax. So you will calculate after tax salvage value is equal to market price minus tax rate multiplied by capital gain. So market price is how much? 10,000 minus tax rate is equal to 0.45. Capital gain is how much? 10,000 because both 0 book value. So what is the answer, by the way? Anyone? Can you give me the answer?
$5,500, sir.
Total answer, right?
Yeah, total.
Right? So it means that in the last year, you have to adjust this information. So it will be plus 5,500. So the last year cash flow will change. Okay. So the last year you will write this answer. Did you get it? So this is, you can get the information like that. But also there is another situation, okay? So please tell me if you have already gotten this concept that zero salvage value also means that you can sell it at some price. Can you just say yes in the chat box so that I know that you got it? Okay. Now let's create another situation. Okay, situation number B. Sometime the question says that, let's say, situation is like that the question does not give you the market price. If the book value is 0, no issues, and question does not give you any market price, so then there is no issue. Then you shouldn't be worried. Okay. If the question does not give you any market price, but there is a thing that you should understand. Okay, so let me delete this. Okay, so first thing we understood, that was book value was 0, but market price is there. Okay, sometimes questions say that, let's say the machine useful life is 10 years, but let's say the project has ended at year 9. Okay, are you getting me? So instead of year 10, this is the asset life. It means the question is telling you the asset life is 10 years, but the project is over at year 9. So it means this should be the terminal year. Okay, so you say that, okay, at year 9, the book value is, what would be the book value, students, by the way, at year 9 of the new machine? 15,000, right? Okay, so actually I have made few questions for you. I already had a recording last time I gave it to students, but you should understand this. Okay, so in this situation, the question has given you the book value, but the question, if you see at year 9, the book value, you see that the asset has not still used. So let's say the book value is 15,000 that is left. I'm just assuming, okay? So you can calculate that. So let's say book value, when you complete the project, because this is asset life is 10 years, but we are going to complete this project in year 9. So asset book value is 15,000. Okay. The question does not give you any information on the market price. So what does it mean? So it means that you have sold your asset at the book value. Okay. So whatever will be the book value will be your after tax salvage value. You have to adjust. Okay, did you get it? So let me okay, so first let's complete this question and then I will explain this to you. Okay, so first let's cover this question and then I will explain. You work for Apple. After toiling away on 10 million worth of prototypes, you have finally produced your answer to Google Glass eyeglass. Eyeglass will instantly transport the wearer into the world as Apple wants you to experience it. iTunes with the wink of an eye and blah, blah, blah. I mean, you think that these will sell for 5 years, okay? Until the next big thing comes along. Revenues are projected to be 4 million per year along with the expense of 350 million. Okay, so I will show you. The question is saying that if the new if the project is successful, this will be sale every year for how many years? For 5 years, and cost is also given 350. It means sale is given, CGS is given, so every year for 5 years it is given. Perfect. Now you will need to spend 60 million immediately on additional equipment that will depreciate it using the 5 years macro schedule. So how much is the cost? How much do you need to spend? 60 million. Okay, so 60 million. So let's see it here from here. So this is at year 0. So you need to spend how much? 60 million. Okay, we got it. So it will be in the year 0. Additionally, you will use some fully depreciated existing equipment that has a market value of 10 million. Okay, I just explained this situation to you in our previous question. You see that the question is saying that additionally you will use, it means in this project, when you will start this project, you will also use some already depreciated equipment that has a market value of how much? 10 million. Okay, so I'm just writing it that the market price of the existing fully depreciated asset is 10 million. So it means that the book value is equal to 0. So you will also use this hardware in the new project. Okay. As glasses are an outcome of R&D center, the company plans to charge 5 million of the annual cost of center eyeglass to the eyeglass product for 5 years. So this is again a sunk cost. So you don't need to be worried because this is an R&D expense. So R&D expense is not basically part of your costing. Okay. A cash flow estimation. Finally, the company's working capital level will increase from their current level of 120 to 140. So currently the working capital is 120, but once we start this project, it will immediately jump from 120 to 140, immediately mean in year 0. They will remain at a level until year 5, mean at the end of the project, when they will return to 120. So initially they will increase from 120 to 140, and then it will get back to 120. Apple discount rate is 15% and its tax rate is 35%. Calculate the free cash flow and determine the NPV of this project. Okay. Now, it means that the company can use this information is very important. Students normally they make this mistake. Okay. The question has given you that the book value is 0, but the market price is 10 million. So if I want to calculate its after tax salvage value, how can I do that? So after tax salvage value is equal to, how much is the tax rate, by the way? 35. Because all of the information given is very easy to understand, but this part will create problem for some students. Okay. So after tax value is equal to market price minus book value multiplied by tax rate. Okay. So this is, so market price is 10 million. I'm just writing 10 minus 10 minus 0 multiplied by 35%. So the answer will be equal to 6.5 million. Correct me if I have written some wrong answer. Okay. So it means that if now, if now the company wants to sell this asset, the company can get, it will be an inflow for a company if the company sells it. Okay. But the company is not selling it, company is using it, right? So in other words, if you see, the company is thinking to use the fully depreciated equipment that has a market value of 10 million. So it means if the company wants to sell it, company will get this much, but company is using it. Okay. So it means, will this be an opportunity cost or what? Company can earn it, but company is not earning it. Okay. Company is using it. So you will see that this 6.5 is written negative. Okay. So in other words, company can use it. It is an inflow for the company, but the company is not selling it. So when it is not selling it, it means it is a cost for a company. It was benefit, but company made it a cost. So it will be part of the project. Okay. So again, it is a cost. So far we got it. Okay. Any problem so far, students? You can stop me if you fail to understand any of the particular part of the question. Okay. For the working capital, before we move to the makers, we need to see the working capital. Okay. So current working capital is 120. So when the project will start, immediately it will increase to 140. So it means we will need more funds. Okay. So capital level increased from 140 to 120. So we need more funds to buy an extra 20 million worth of working capital. We will buy. So when we will buy this, it means that it will be an outflow. Okay. So it means that by starting this project, our working capital will increase. When it will increase, it means we will need more funds. When more funds mean it will be an outflow. So increase in working capital is an outflow. After that, it is constant. It means it is 20, 20, 20, 20, but the difference is 0. So you will not use this one. You will not use 20, 20, 20, 20. We will only change the difference. Difference is 0. Okay. But once the project is over, it will again get back to from 140 to 120. Okay. So from 140 to 120. So it means previously we were using an extra fund of 20 million, but now we are not using that extra 20 million. So when you are not using, so it means your total cost is now 120, less of 20 million. So when you are not increasing your working capital, it means you are not paying. When you are not paying, it is your benefit. Okay. So decrease of the working capital level means an inflow. Increase in the working capital means an outflow. No increase, no decrease. You will just use 0, 0, 0. Okay. So as you can see from the working capital, when you start, how much is the difference? This 20. Okay. Then 0, 0, 0, 0. And at the end of the period, it is plus 20. Okay. So far, we have also covered the working capital. So about the depreciation, it's a 5 years makers. So this table normally will be given to you in the exam. So don't worry about that. So in the exam, you will be given makers table. Okay. The 10 million is on prototype. So again, it's a sunk cost. So you shouldn't be worried because this is not related to your cash flow estimation. So in year 0, the rate would be 20%, 32%, 19.2, 11.52. And don't worry, these rates will be given. Okay. So these rates will be provided to you. So what is the cost? Cost is 60 million. Okay. Cost is 60 million. 60 million multiplied by the rate. Okay. So 60 million multiplied by 0.20. What is the answer? Is the 12 the correct answer, students? Okay, then 60 multiplied by 0.32 will be this answer. So 60 into 19.2% will be this answer. And you can keep on doing that. And these are your answers. Okay, so these are depreciation expenses for 5 years. For 5 years, but the numbers will be 6. Okay, so it means that we are going to, depreciation is here. Negative 12, 19.2, 11.5, 6.9, 6.9, and 3.5. So how did I calculate it? You multiplied your cost with the depreciation rates. These rates will be given to you in exam. Okay, so you will just multiply your cost with these rates and get the depreciation. Okay, now the question is very simple. In year 0, of course, no revenue. In year 1, 450, 450, 450 until year 5. So these will be your cost. So depreciation, negative 12, negative 19.2. So your answer will be 80.2, taxable income, and taxable income. But if you see here, your taxable income is negative. But on negative, when you don't pay any tax, so it will be a tax saving. If you calculate 35% of 12, it will be 4.5, but not negative. It will be an inflow. Okay. So it means that 12, negative 12 plus 4.2 will be negative 7.8. So this is your net income. Okay. So depreciation, you will add back. Previously, you had subtracted that, and now you are going to add back the depreciation. And capital expenditure is 60. Opportunity cost is 6.5. And working capital is 20. So it will be 82.3. Okay. And the rest of the cash flows, as you can see, simple. This is your taxable income. you pay tax, and then this is net income, add back depreciation. Okay. And all of the answer, you will get it 71.72 in year 1, 69 in year 2, 67 in year 3, in year 4, you will get 67. But in year 4, 5, you are adjusting the working capital because in year 5, it will be an inflow. So you will adjust it. Okay. So if you calculate the NPV, you will get the answer. Okay. So the question that I wanted to answer previously is already given here, that this is already answered in the question, but you can expect a video from me where I explain the life of a project and a cost and life of the asset, and I gave some example as well. So I will share that video with you. I made it last year for the students, so hopefully that will help you. If you want to ask any question, let me know.